Joining me now is Thomas Hayes, founder and chair of Great Hill Capital. Thomas, great to have you on the show down here from the floor of the stock exchange. Thank you.
Thanks for having me. Glad to be here.
All right, let's start with this Alibaba news today. The stock up wildly in a sea of mostly red, fractional losses for the major indexes. There's a look at the intraday chart. What does this mean for this stock and perhaps the sector?
Yeah, this is an historic day for Alibaba. We've been waiting for this. Value investors like me have always had the thesis, sum of the parts is greater than the whole. If you look at the 6 parts, just take a look at Aliyun, which is the Ali Cloud business, the equivalent of AWS in the US. This business alone did $11 billion of revenue last year. McKinsey expects the cloud industry to grow 3 times, to triple by 2025. The Ali Cloud has 38% share. That means they'll be doing $30 billion a year in revenue. Operating margins will expand to the mid to high 20s, which means $10 billion of operating income. Now, as a standalone, that will be able to command a higher multiple than within the larger company, whether it's spun out to shareholders or IPO'd. You put a 10 to 20, more like a 20 to 25 times multiple on a fast-growing business, you have a $200 to $250 billion business. That's just one division. You get the other 5 divisions for free. Yesterday, the entire business closed at $220 billion. So it gives you an idea of the value lock over the next 12 to 24 months. This is a big deal, and it shows discrete opportunities in a bearish tape.
And it is interesting, right? A Chinese company executing this. Do you expect this in this current environment from U.S. companies?
Yeah, I don't think it's going to be immediately in the U.S. companies. You are going to see a lot of spin-offs in the U.S. companies. You're seeing it in 3M, you're seeing it in Baxter, you're seeing it in some of the established blue chip companies in the U.S. But as far as breaking up companies, et cetera, like you're seeing, this is a Chinese story. Particularly, you may start to see it with Tencent, you may start to see it with other companies in emerging markets.
Interesting. Now let's talk about the state of the overall market. Of course, we were hearing the testimony on Capitol Hill today about these banking collapses 2 weeks ago. Seems like there is still some concern, lingering concern out there in the market. What do you see as the path forward for stocks?
Yeah, well, you saw First Republic down and Pacific West Bank Corp today down, both about 5%. This is not fully over. We're going to have some bumps and hiccups along the way because it's not just one mismanaged bond portfolio. The issue is the genie's out of the bottle, and there's going to have to be some type of temporary backstop on deposits or some increase in FDIC insurance, which the executive branch can do unilaterally in times of crisis. They don't have to wait for it to go through Congress. So I think you're going to see more bumps like that. But we are constructive on the market because if you look at the Bank of America Fund Manager Survey, which came out just a few days ago, managers are more pessimistic than they were at the 2009 lows, the Great Financial Crisis.
Wow.
I know you're too young for that.
Oh, I remember that. I wasn't down here, but I do remember that.
And more bearish than the Euro debt crisis and more bearish than the pandemic lows before we even had a vaccination.
Wow.
So you have that. You have recession fears have come off a little bit, which implies historically when that happens that the bottom's already in. And we're of that camp that the October lows are the bottom because the market bottomed 6 to 9 months before earnings bottom. So even if you're a little more pessimistic on earnings coming down a little bit, we think that's a pretty solid bottom there in October, and we think there are things to do, opportunities.
Okay, so let's, I guess, talk about some of these opportunities. I guess we can talk indices, sectors, and then maybe get into some individual picks in this current environment.
Yeah. So the Fed has 0 to 1 more hikes, and historically what we see is that 6 months out, after the Fed pauses, you're up 13+%. 12 months out, you're up 18%. This is since 1984. And 24 months out, you're up over 30%. No one's positioned for that. Now, in a slower growing environment, kind of below trend here because of all the tightening, what works? And we like healthcare as our theme, and we particularly like biotech. This reminds us of the tightening cycle from 2015 to 2018. Biotech, the ETF XBI, it dropped 51%. In anticipation of the tightening cycle. It rebounded 135% over the next 24 months. This time around, 2021 to 2022, in anticipation of the tightening, dropped 65%. We expect it to rebound at least 100% over the next 12 to 24 months. It's a lot of opportunity there. Multiples are below historic averages. To get just back to the average, and we always overshoot on the upside, just like we're overshooting on the downside. Get back to the average book value. The sector has to go up 25%. Price to operating cash flow up 150% from here. And forward PE up over 110%. So there's a lot to do. The themes are deals and drugs. You saw Pfizer buy Seagen, just the tip of the iceberg at $43 billion. We're going to see a lot more because Big Pharma's got $500 billion of cash, and they've got to buy the innovation now that they've got the patent cliffs.
So does that insinuate that growth names will outperform? I mean, you look at the major indexes, the Dow, the S&P, the NASDAQ. I think people are trying to kind of discern where we move from here.
Yeah, we're kind of in an information vacuum 2 weeks ahead of earnings, so but we do think with rates coming down and you're seeing the 10-year yield, we think there's going to be a persistence with tech. You know, they were kind of the worst performers, tech, communication service. They're outperforming this year. We think that's going to persist. They've moved a lot, so they have to kind of digest. We're seeing in the last day or so. I think they'll digest, but I think that the trend is going to persist. I mean, when you've got an Amazon down 55%, that's a high-quality business. Even Alphabet, some of these bigger tech companies are going to be opportunities moving forward, in addition to the healthcare names that we've discussed.
I wish we had more time, Thomas. It's always good to get your take down here on the floor of the stock exchange. Thomas will be back soon, of course. Thomas Hayes, chair of Great Hill Capital. Thanks.
Thanks so much.
Okay, let's take a